Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, we've seen some clouds gathering from the macro and policy front in recent days, particularly in the US, and we've seen that play through not only in tariff announcements, but also in some of the recent macroeconomic data. On the other side of the world, of course, in the Chinese equity market, the technology sector remains on a tear as the deep-seek optimism continues to extend. So the question is this just a bit of a blip in US markets and the economy, or is this something that investors should pay a little bit more attention to? To discuss that and more, today I'm very happy to be joined by Rajat Bhattacharya, who helps run macro strategy at the CIO office. So welcome, Rajat. Thanks for taking the time to join us today. I suppose we'll get sort of right into it. Let's start with the recent softening of U.S. economic data. In your view, what's important here, and how should investors be positioned?
Thanks, Manpreet, and glad to be here. So, as you mentioned, what we're seeing is U.S. consumer confidence has begun to wilt amid rising political uncertainty as U.S. President Trump shakes up U.S. trade, immigration, government employment, and foreign policies. Now, this week, Trump reiterated plans to impose tariffs on Canada and Mexico from next week and increase tariff on China by another 10%. Remember, China is already facing tariffs of almost 20%. So he has also signaled tariffs are coming for Europe. Now the S&P 500 index and the US 10-year government bond yield are both down since the date Trump was inaugurated on 20th January, and US earnings expectations have come off since their January peak. These trends suggest that investors are getting more worried about the growth rather than the inflationary impact of Trump's policies. Our base case is that the central bank rate cuts and lower bond yields should help mitigate any downside risks. Likely modest fiscal easing in the US, China, and Germany is also another potential shock absorber, if I may, against any trade war escalation. Also, Trump is likely to recalibrate his policies if they negatively impact stock and bond markets on a sustained basis. In the near term, though, we would rotate into China technology sector equities as US stocks potentially pull back another 3 to 4%. We would also fade the recent euro rally that we've seen in recent weeks as safe haven demand lifts the dollar.
Thanks, Rajat. I think some interesting points you left off there, which I want to dig a bit deeper. So let's talk a little bit more about the economic indicators and the markets a bit more closely. And on the equity market particularly, how far do you think the recent move can go?
So let's take the economic data first. Recent US economic data has been weaker than expected. The US Service Sector Business Confidence Indicator, or PMI, for February suggested contraction in activity for the first time in 2 years. Two widely followed measures of consumer sentiment have fallen sharply in the past 2 months, while inflation expectations have risen. This follows weak retail sales and a drop in aggregate payrolls data, which takes into account total payrolls, average hours worked, and average hourly earnings. The consensus estimate for US 12-month forward earnings per share growth has also slipped to 12.5% from a peak of 14.8% in late January. Now, the market has focused on slowing growth metrics as Trump reiterated his plans to impose tariffs on Canada and Mexico from next week and increase tariffs on China. The S&P 500 has fallen from a record high hit only a week ago and has broken below its 100-day moving average. There could be further 3 to 4% decline, with the next key support for the index at around 5,764, followed by 5,697. The US 10-year government bond yield fell through a key support of around 4.4% and is testing the 200-day moving average of 4.24%. A break lower could take it to the 4% mark.
Now, you mentioned that central banks and fiscal policy can potentially come to the rescue. Could you just walk our listeners through that reasoning in a little more detail?
Yes, let me do that. Although Trump considers the stock market as a good yardstick for the efficacy of his policies over the medium term, we believe his immediate aim would be to lower bond yields. On that score, a moderate growth slowdown would not be a bad thing, especially if the resultant decline in bond yields helps Trump implement his tax cut proposals without significant challenge from the so called bond vigilantes. This week, the Republicans narrowly pushed through the House of Representatives a budget bill that will add almost $2.8 trillion dollars to the deficit by 2034. The bill is likely to be amended by the Senate, but there is a good chance that the net impact will be modestly stimulative. Also, moderately softer growth is likely to encourage the Fed to resume rate cuts in the second quarter, in turn easing financial conditions. In fact, money markets are once again pricing in just over 225 basis points of rate cuts by the end of the year, instead of just one cut priced only a week ago. Besides, also we should note that the investor positioning is not too stretched. These factors should limit the equity market downside and be ultimately positive for stocks.
All right. Look, let's maybe shift gears a little bit now and talk about Chinese equities. I mean, we're obviously seeing quite a strong rally. What's your outlook there, particularly on the technology sector?
Yes, we remain bullish on the Hang Seng Technology Index, which represents the Hong Kong listed technology, China's technology sector. That now this has been leading the way, the rally in the Hang Seng Index in recent months. We believe the emergence of China's low-cost AI-powered chatbot DeepSeek provides a fresh impetus to China's technology sector. We expect DeepSeek to expand demand, speed, and performance of a host of technology infrastructure, equipment, and service providers, helping narrow China's valuation discount with US stocks. It is worth highlighting that despite gains made thus far, the Hang Seng Index is still trading at a 42% discount relative to global equities, which is about a whole standard deviation cheaper than the 10-year average. We believe while a mild pullback in Chinese equities is possible in the near term due to US tariff announcements and chip restrictions, the support for the Hang Seng Index has moved higher to around 21,600 level. One other key driver of the equity market will be China's upcoming National People's Congress next month. Fiscal stimulus from the Congress would provide further upside for China equities by boosting domestic consumption, which should help offset the impact of US tariffs.
All right. And finally, of course, we've had an election in Germany recently. In your view, very quickly, how does this impact your view on European bonds and the currency?
Yes, so Germans' election results likely delays the chances of an early fiscal stimulus, and thus that is positive for government bonds and negative for the euro in the near term. Based on the results, the Conservatives and the Socialist parties together have enough seats to form a coalition with majority support in parliament. However, they will need other partners for the two-thirds majority required to ease Germany's strict fiscal policy rules to enable the government to boost infrastructure and defense spending to support growth. While the parties bargain with the left to form a grand coalition, European government bonds are likely to benefit from ECB rate cuts aimed at stabilizing growth. We continue to expect 325 basis points of rate cuts by the ECB this year, including a 25 basis points of cut next week. Now, the rate cuts are likely to accelerate if Trump follows through with his tariff plans against Europe by April. Against all of this backdrop, the euro dollar rally is likely to fade with the first technical support at around 1.033, followed by 1.1014.
Okay, well, I think that brings us to the end of the time we have available today. Thanks very much, Rajat, for taking the time as always. If I can always summarize my top takeaways from this conversation, number one, as we just ended, we would fade the rise in the euro. Second, China technology sector, at least in the short term, we think it's a good rotation opportunity. And third, the 10-year US Treasury yield, appears likely to test the 200-day moving average around 4.24%. So that's all we have for today. Thank you again, listeners, for taking the time to join us today. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.